Good evening, everybody. All right, we got the great pleasure of having Ron back with us tonight. And the reason I say great pleasure, every time Ron comes on, we get lots of good feedback about the information that he provides everybody. He's been around for a good while, and he's a good trader, and he loves to teach people how to trade. So he usually has some very interesting techniques and applications. So with that, Ron, welcome back to the Candlestick Forum. We're anxious to see what you got.
Hey, Steve, thank you so much. Nice to see you again. And hey, everybody, it is very nice to be here. If you guys remember, when we took Financial public, even before that, we actually gave Steve a call because he is one of my most favorite presenters. So the first place we ever released Financial was to you guys. And you guys went through, did a beta test, gave us tons of great feedback, which we were incredibly happy for. And man, you fast forward a year later, and it's been an amazing ride. So we have a ton of members from Candlestick Forum over at Financial. Just a big thank you. If you guys are here, feel free to say hi if you're already members over there. And it's been a little bit since we've been over, so it's great timing to be back with the new year. Today's webinar is going to be interactive. You will be able to type in stuff. I'll be able to read it. I can hit you on the fly with the questions. If we get too many, I'll pick off some in between, and then I'll hit them all at the end. So, before I go any further, the lawyers make me do this. I always must show a disclaimer. Nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. Past performance is no guarantee of future performance. All right, the lawyers are happy. Now, let's have some fun. So there's no PowerPoint deck. We're going to be doing stuff on the fly here. Oh. And when I spoke to you guys a year ago, in the very first webinar we did, it was actually about a year and 2 months, I asked you, what's the number one question that we have as traders? And it sort of comes down to, we're going to spend a lot of time doing some research. I love candlesticks, so we send our people from Financial over to Steve to get educated on them, because he does such a great job. But you know what? Sometimes you can have two amazing bullish engulfing patterns, or hammers, or haramis, or kickers, and you just can't figure out which one maybe is the one that you'd like to go after. Well, what I'm going to show you right now is the ultimate tiebreaker. So when we do all that homework, and we do all that research, and we're trying to figure out maybe which one do we want to go with, this is going to solve that problem for everybody. So what we do is we're going to go to Financial. You can type in any ticker symbol. And now we're inside the site. So we're going to do two things. Not only are we going to do the tiebreaker effect, where we can pick this versus that, but there's something else cool we're going to do right now. In the emails that Steve and his team sent out to you guys, I promised that within a couple minutes of going live, I would show you the hottest stocks for the next year, right? Or the hottest stocks for the next 6 weeks, or 8 weeks, or 12 weeks. That's what we're going to do right now. So instead of wondering, which stocks might be likely to go higher, or which stocks might be likely to go lower, we can be laser focused. In fact, here's what I want to do. I want to come over here and hit screen. We're going to click Seasonality. And then I can come over here and pick from my settings, which we'll cover in a second. And let's say I want to look out 12 weeks. Watch what happens. And if you guys want to take a picture of this, you can. I'm okay with that. Just don't share it with anybody else. Hey gang, over the next 12 weeks, this very specific list of stocks has a probability of going up 70% of the time. 70% of the time over the next 12 weeks. Let me say that again. This list of stocks has a track record over the next 12 weeks of going up at least 70% of the time or more. So we're coming into the weekend again. Instead of spending 3, 4, 5 hours away from our families, maybe we want to go fishing. If you're where Steve or where I'm at, I'm in Allentown, Pennsylvania. We're ice fishing right now because it's been so gosh darn cold up here. But maybe you want to go play golf if you're in Florida, or take the kids and go sleigh riding. Instead of wondering which stocks are likely to move, here we can start. And now that we have this list of hottest stocks, now we can go apply candlestick analysis. Now we could say, hey, what are trending? Where's the 8-day EMA? Do we have bullish engulfing, bearish engulfing, etc.? This is where we begin looking instead of saying, I wonder what might go up tomorrow. Now, the next thing you might ask is, well, stop right there, Ron. What is this? I mean, how do we know that these stocks are likely to go up 70% of the time? Historically speaking. Are there any engineers here? Are there any scientists? Are there any folks that like black and white? They don't like hearsay? This is for you. Most of my friends are engineers. I wonder what that says about me. All we've done is taken the stock's historical data available in the marketplace, given each week the same value, we add it up, and these are the stocks that move this time of year. It doesn't matter what I think. It doesn't matter what you think. It doesn't matter what anyone thinks. It's the stock's own track record that produces these kinds of crazy results, seemingly year after year after year. Have you ever looked at a stock chart and said, the stock was sort of going nowhere for a while, and then all of a sudden, the stock just has a rip-your-face-off move to the upside. It just starts running and running and running, and you're wondering, geez, what caused that stock to go higher? What did seemingly everybody else know that I didn't? Or back to the beginning. You could have picked stock A or stock B. But you picked stock B, and stock A is the one that went up. Here's the answer. See, if you check the stock's historical track record this time of year, it's called seasonality. You might ask, why does seasonality work? It's big money. Now, some of you guys might be really big traders that are here today, and that's awesome if you are. But the average trader is considered a retail trader, where you might trade a couple contracts or a couple hundred shares. Maybe it's 50 contracts for an option trade. Maybe it's 10,000 shares. Even if we all pooled our money together today, chances are we might make it to one block trade on CNBC's ticker, and then it's over. We can't move the market. So for these kind of track records to occur, the big money's got to be there. The big fish, the big piggies. The elephant's got to be walking in to feed. And when they feed and when they buy, that's what pushes stocks. Now, if you've never seen this presentation before, you might say, I don't know, that sounds pretty easy to me. It almost is too good to believe. I got to tell you, gang, one of our team members worked for a hedge fund, a big, big hedge fund, had to sign an NDA. They are completely aware of seasonality. Why? Because they're the ones that are causing it. They buy the same stocks seemingly year after year at the same time, and they sell them year after year at the same time. I'm going to show you a couple examples that are probably going to knock your socks off when you see how, quote, easy they trade up and down throughout the year. It's just astonishing. So if I just show you my settings here, I look for stocks that rise at least 5% over the next 12 weeks with 70% accuracy. I want them to be optionable. I want share price at least $10 a share. And then I think this one is really important because the minimum number of years of trading history, ever since the market bottomed in 08 and 09, most stocks have gone higher. So I use the saying that even a blind squirrel can find a nut once in a while. You just get lucky by accident. So if I look at a stock like maybe Facebook or Alibaba or Snapchat or Twitter that maybe only came public a few months or a few years, it's really not a good representation for how seasonality works. And I just want to point that out. So for me, I just go minimum 10 years, because if that stock even was up this time of year when the market was crashing in '08 and '09, well, holy Toledo. I mean, if it can go up then, geez, it might be a rock star of a stock every year, it seems, during this time frame. And then I just have 30-day average volume. Actually, the folks from Steve, a lot of you guys asked for that. So we added this one in here too. If you said to me, well, you know what? What if I only want to look out 8 weeks? So you just want to look out 2 months, not too far. And I scroll down, all the data's changed. Now we have the old Smith & Wesson, but we have Netflix, Alkermes, I believe it's called. I don't trade that stock, but ALKS, it's an easy symbol to remember. Cheniere. We have Domino's Pizza, Skechers, Applied Materials, Valero, United Healthcare, Shutterfly. These are real companies that we've probably heard of. I mean, there's Take-Two Interactive, Xilinx, Cypress, Big Lots, Silver, the Silver ETF, SLV. So we're not talking about obscure companies that no one's heard of. These are actually real companies. And you might ask, well, if I scroll back up here, why don't I change that 70% figure to, let's say, 80% or 95%? Here's the thing. If we cast such a small net, we're not going to catch many fish. For me, using the software since we built it over a year ago, 70% is a pretty good figure. Let me start there, and we're only going to go there and up. And we can get really, really, laser focused on what we want to look for. So here's what we're going to do. I'm going to scroll back down, and this is the 8 weeks. But over 8 weeks and 12 weeks, now 12 weeks is the first one we looked at, I wrote down some stock ticker symbols, like I wrote down Netflix, I wrote down Domino's Pizza and Skechers. We had Adobe listed, Valero, United Healthcare, Taiwan Semi, Take-Two Interactive, and Skechers. I said Skechers already. So here's what I do. I don't know what OTEX is, and I don't really care. Sure, it goes up 15.74% over the next 8 weeks. But what I like to do is trade the same stock over and over again. And if there's one thing I could tell you guys, is to consider doing the same. It's sort of like if you like playing poker and you get together with your buddies and they have a good hand, a bad hand, you sort of know how they play a little bit. Or maybe it's just a friend of yours. You know how he acts when he's upset or when she's upset. You get a familiarity with these stocks. So given the choice and all things equal, I don't care what OTEX does or Alkermes or VRX or DOX. I want to trade stuff that I trade over and over again because I'm comfortable with them. A little more comfortable than maybe the everyday stock. The first one I want to look at is Netflix. So once we pick a stock, we can go back up, and what we're going to do here is hit search, and we're going to hit seasonality. I can type in, oh, before I do that, watch this. You see I have the spiders on my screen? Let me show you what this is. The left side of that's the solid line. That's what the stock, or in this case the ETF, has done for the last year. The right side, you'll notice it's dotted. This is the probabilistic future price. I can't predict where a stock might go. I wish I could, but I can't. So what we're doing is taking all the stock's historical data and saying if that stock lives up to its historical average, this is what it could do. That's all we're saying. Look at the S&P over, let's say, the next 12 weeks. You see how it moves? And then over here is our plus and our minus. Now if I scroll down, look what the S&P does. will actually tell you. We have a little algorithm that reads the data and it spits it out into text for you. Over the next 12 weeks, the S&P ETF has on average historically risen by 1.2%. So over the next 12 weeks, it goes up 1.2% in 15 to 24 years. So in 15 to 24 years, which is only 62%. This is why financial can be so valuable in helping you guys come up with hopefully the best trade idea you can. All right, the S&P goes up 62% of the time by a whopping 1.2%. Why would I want to trade that when I just showed you the list of stocks that go up 70% of the time and they were all double digits? So sure, we could play the spiders or the diamonds, but they're ETFs. They're not going to move as much. Why don't I come in here and type in Netflix, for example? That was one of the stocks we wrote down. And look out 12 weeks and say, hey, over the next 12 weeks, Netflix has historically risen 24.9% in 11 of 15 years. So 73% of the time it moves higher. All right, 73, almost 3/4 of the time, by 24%, you got my attention. Now sometimes these massive moves are caused by earnings reports. And we're going to touch on that in a little bit, because what I was taught when I got into trading was earnings reports are supposed to be complete crapshoots. We are not supposed to know how a stock is going to trade after the report. If we do, we go to jail, right? That's what we're all told. Now, there's probability setups and things like that that we can use to help. But this is the big money. Remember, this is the big money putting their money down through an earnings report. Netflix reports, let's actually look. I think they report in literally a couple days. I'm just going to go to the CBOE here. I have it loaded up. So they report, in 4 days. So if I bring up my little calendar here, the 22nd is Monday. They're going to report Monday. When I see a massive thrust higher here, that probably has something to do with earnings. That's telling you that 3/4 of the time, essentially, Netflix has a positive earnings report. Huh. And I thought earnings reports were supposed to be complete crapshoots. Maybe they aren't as much as a crapshoot as we all thought. Why do companies do that? Why is this particular report always good or perceived as good? Folks, I have no idea. But the big money puts their money down. They're the ones that drive the stock price. So whether you agree with it or not, it's irrelevant because the data is the data. And I say that sarcastically because it's the truth. We're not weighting this data. The only way we can have such massive skews here is if the company does the same thing over and over again. Well, then you might say, yeah, but maybe it's just the last couple of years. I'm like, well, Netflix has been public for 15 years. 11 times it goes up. I don't know how else to explain it. It is what it is. Now what gets really neat is if I take that slider, I can move it left a week. If I only go out 11 weeks, now Netflix goes up 80% of the time. 10 weeks, it's 80% of the time. 9 weeks, it's 80% of the time. 7 weeks, it's 80% of the time. There's an amazing track record. Now, what does that mean? Well, if it goes up 8 out of 10 times, in theory, maybe I should just go out and buy a whole bunch of short-term long calls, and then we all go get our private jet. Yeah, that's not the way we should do that, because past performance is no guarantee of future performance. They're only telling you what they've done in the past. Even if this had a 100% track record, the next report, who knows what it could be. But again, this is what the big money does. So if you were thinking about being bearish on Netflix next week, and you said, man, the market has gone up so much, Netflix has been going up, there's no way this stock's going to go higher. You had access to financial and you looked at that, man, you may not want to do that, because you're betting against 80% historical odds. You're going to find yourself in a world of hurt. And the same thing goes for companies that are reporting later this week. Well, later this week is Friday, or next week when the deluge really starts. Do you ever wonder why your stock's in an uptrend and then all of a sudden it gets down 20%? Answer? Did you check the seasonality? Maybe the big funds were selling to all the suckers as the stock was going up, knowing full well this is the time of year when the company reports a weak quarter. I'd like to ask you a question. I want to be very aware of your time. So my goal here is to try to keep this to about 40 minutes. The only way I'm going longer is if you guys want me to. So I want to be pretty precise. I would like to ask you a question, and I'd really appreciate if you'd play along. If anyone knows the answer to this question, refrain from answering. Can someone tell me when the best time, historically, is to own Disney stock? So I'm talking about the Mouse House, Mickey Land, Minnieland. What time of the year do you think? Do you think it's maybe the summer when the theme parks are so full the parents are pulling their hair out? Or maybe it's the winter, between maybe, Christmas and Hanukkah and New Year's, maybe when winter break is out, or maybe it's the springtime for spring break. All right, I really appreciate this. So you guys are giving me a lot of answers. We have December, we have summer, April, fall, July, spring, winter, specifically November to January. Abdul says Christmas, December, October. Okay, Diana says, how about December and the summer? All right, thank you so much. I'm in your boat. I really wasn't sure. I didn't know. So then what I did, and this is the cool part, is, by the way, a year ago, when I was in the room with Steve's folks, you guys, we did Disney, and we said, we're going to find out real quick if this seasonality stuff can actually play out. And I want to show you something. When I take this line on this little slider on the center of your screen, and I move it out 52 weeks, I can actually forecast out if the stock lives up to its historical track record, what the stock can likely do. Meaning, it can go up, it goes down, and it goes up. Disney's been publicly traded for 45 years. Okay, let me say that again. 45 years. When I looked at Netflix, it was 1/3 of that. It was only 15 years. So we're talking a company that's been around half a century. And you're telling me, year after year, we get all of these things aligning, the stock actually goes up, the stock actually goes down, then the stock actually goes up? If you're not familiar with what causes that kind of surge upwards and downwards, you need year after year after year after year of data all aligning the same way. Otherwise, it would just be a straight solid line because everything would average out and there would be no bias. So to have 45 years of data and have a line like that and a line like that is absolutely extraordinary. And it's the big funds that are doing it. Over the last 45 years, we've had Democratic presidents, Republican presidents, we've had a few aliens in the White House, we've had debt crisis, war, we've had a lot of different things. Yet the stock just seems to do what it wants to do. All right, hold on to your hat. I'm going to show you something. A year ago, like I said, if you were here early, Steve was kind enough to let us demo financial for only his people over a year ago. We didn't want my name attached to it. Some of you guys know me from Market Tamer as well. and we wanted to be, quote, hidden. We just wanted someone to play with the software. Steve was awesome. He's wonderful. He said, sure. So we demoed it to you guys first. And here we were, a year ago, in October. It's now about a year and 4 months. And I said to you then, there's going to be two things we're going to look for if Disney is going to live up to its expectation. We're going to look for a spike in volume, because that is where the big fish can't hide. And we're going to look for the stock to start breaking trend lines, something. Now, one of the really cool things that I like to teach is the orange line on your screen. Now, that can be found on any brokerage platform. It is the 50-day SMA. So I'll type that in for everybody just in case it's hard to hear. 50-day SMA is a simple moving average. That is considered institutional based. Some folks like a 50 EMA. It doesn't really matter. I was taught on the 50 SMA, and I find it to be pretty great for me. Okay, so we'd just be splitting hairs if we changed it up a little bit. So the orange line, if stocks are above it, they're considered institutionally positive or bullish. When stocks are below it, you could assume that they're not bullish or maybe even bearish. Now, there's a bunch of other squiggly lines here. The purple line is the 200-day SMA. That's even a bigger institutional average. But I consider myself a swing trader. And for me, I'll look to hold stuff for a couple days, a couple weeks, maybe even a couple months if things just go so well I can't look a gift horse in the mouth. So, a couple days short term, maybe a couple weeks middle term, maybe even a couple months. That's what I consider long term. So here we were with you guys, before financial was even publicly released. There's a volume spike to the right of your screen. All of a sudden, that orange line is broken right at the end of October. Then it starts moving. Then the earnings report comes. Look at the volume. If I zoom in really close here, there's the earnings report. And by the way, the brokerage account I'm using is Thinkorswim. This is called profit charts. Look at the volume before the earnings report. The earnings report was here. Then the next day it gapped up. They were buying in front of the report, on the report, after the report. And look what Disney started to do. Are you kidding me? So Tom, hey there Tom, he nailed it. The best time to own Disney is typically the end of October into April and May. This stock is an absolute rock star. It runs at accuracy rates historically of 80+%. It's one of the easiest trades I've ever seen. I said that to you a year ago. I said that in the webinars I did at Financial this fall again. By the way, this call, just waiting for it to get back above the 50-day, and then following it all the way up to April 10th. I believe it was 296% return using an April long call. And the exit strategy was if it gets below the red line. And when Steve said I like to keep it simple, gosh, I really, really do. It's one of the reasons I like Steve. I like the way he teaches. Steve likes to keep it simple as well. The red line is the 20-day EMA. I'm not here to say some kind of indicator with my name on it that, is only found somewhere. It's just simple stuff. When they come in, look at the volume. By the way, black is up volume, red is down volume. So if the stock finished up on the day, it's black. If it finished down, it's red. Look at the big fish coming in here, here, and here, and they just kept going. The October earnings report, the November earnings report and the February earnings report are usually bullish for Disney. The spring and summer reports are bearish. This is where we were a year ago. Now this is 2017. Look at the stock go down. That's just like the financial data said. Please keep in mind, I'm not trying to tell you that our financial data is so super secret. All we've done is spent about $200,000 to create something that the average trader can use. We spent a crazy amount of money. And all we've done is taken the stock's data and just laid it out there for everybody to see. And then down she goes. Watch what happens. Right there, I'm going to stop. Okay, follow my mouse. Do you see where I'm circling right now? That was the summer. At the end of July, right, my wife and I, we actually went to Australia in August, which is absolutely amazing. The Australian people are just incredibly awesome, polite, helpful. I could live there. But I remember this because it was right before we left for Australia. I did a webinar for all the members at Financial. And they said to me, hey, Ron, remember that Disney stock you always talk so much about? I'm like, yep. Well, everybody did great with it, pretty much, because of the major run. But they said, Ron, I thought you said that the data suggests that really the only best time to really own Disney bullish is November to May. I said, yep, I don't say that. The data says that. But they said, but Ron, look at the stock. It's above moving averages. It's breaking out right in front of the earnings report. Now, I'm from the country in Pennsylvania, so basically I grew up as a young boy. If it moves, you can eat it, and it goes on the dinner table. We grew up pretty poor. So the analogy I might use here may not be the best, but it's the one that I think really drives home an emotional point. What I believe the big traders were doing is they were sucking in all the easy people just to set them up for slaughter. Because this move higher was against all the probabilities, not my probabilities. The stock's 45-year historical track record suggested there's no way this stock's going to run. And look what happened. They lured all the retail traders in. Earnings comes out, and then people scratch their heads and say, oh, gosh darn it, gee whiz, the stock just dropped 5% in a day. And then it kept going down. And then it went sideways and went nowhere. If you had access to Financial, you knew when the great time was going to be, and you knew that if you had stock, it was time to go into a collar trade if you couldn't sell it. Buy a protective put, because you know the April report's typically a stinker. You know the August report is a stinker. The good reports are November and February. Guys, this is what's happened to Disney since. Last year, in 2016, Disney started moving at the end of October. In 2017, it was the first week in November. So they're not always going to be week over week accurate. As long as we're close, that's all we care about. There goes Disney. Look at the volume. Volume. Here's the earnings report. It's like, are you kidding me? They bought Disney in front of the earnings report again, just like they did last year. It gaps up, pulls back to the red line. It rips up, pulls back to the red line. Rips up, back to the red line. Rips up, back to the red line. From here to here, it's triple digits already. Now, I don't know if you guys follow the Bollinger Bands. I do. I've actually been doing instances of selling into the bands and then buying back here and then selling and buying. I've been doing the timing. But if you don't want to time it, just follow the red line. This is another triple digit return. Year over year over year, it's absolutely uncanny. So now that you can use Financial to see how your companies act throughout the year, you're no longer wondering, golly gee whiz, why did the stock go down on earnings? You knew that was likely to happen. It goes up on earnings, and then it goes down, and now it goes up. So for me, as long as Disney stays above the red line, which I think is a fantastic moving average. Remember, 20 days is actually a whole month's worth of data on the calendar. That's a lot of data. So if it stays above it, it's viewed as bullish. Below it, we can just exit. So if I go back to financial, no longer are you left wondering, what does my stock do this time of year? You actually know precisely. Now for me, I prefer to trade options over stock because I can get leverage that way. I'm not talking about margin, just the actual leverage. So I can trade expensive stocks at a fraction of the price. Now typically what I do, because the idea here for Disney is it stays bullish all the way out until April or May. So whatever time frame I'm looking at, that's how long I could buy a long call for, and then I would just add a month to it. So if I'm looking out, let's say 4 months, that's 120 days. Add a month to it, 30 days. Now we're at 150 days. And the reason I do that is very, very simple. Time decay is its most noticeable inside the final 30 days of expiration. So if you want to hold that call option, it's into the final 30 days, that's usually a time I want to start thinking about dumping it. Because whatever extrinsic value is left on there is just going to bleed off, and you're just flushing money down the toilet unnecessarily. So the simple way is whatever time you're looking for, that's the amount of time on your long call. But then I say, hey, add an extra month to be safe. And I think you'll find that works. And typically what we do, when Disney was back here, let me just show you what happened, because this is what's going to blow your mind. I'm going to go to Analyze inside Thinkorswim. I'm going to type in Disney. I just got to wait for Thinkorswim to load up here. Okay. And Disney started breaking out back here. The volume came in, it got above the orange line, it's game on. Now that was right in front of an earnings report. So I could have waited for the earnings report to come out and still done incredibly well, because a $10 move, a 10% move on a stock, using at-the-money options, it makes your head spin at how much these options can potentially gain. Just to show you, I highlighted the breakout for our members on the 6th. Watch this. I'm going to go back to November 6th, and I hope you are sitting down. At the end of the day, a call option for April. So let's say we wanted to hold the trade to March or April. April's good enough. I could have done June as well. So, Diana, I appreciate your question. It doesn't really matter whether it's April or June. I would just say pick the time frame you want and then add a month. So let's just use April. An at-the-money call is $3.55. Excuse me. The reason I go at the money is very simple. It's affordable to most traders. You could make a wonderful argument and say, well, why aren't we going in the money and buying a better delta? We also buy less time value. Yeah, but you're paying more for the option. So if you're wrong, you're going to get beat up pretty much, right? So we're going to buy long calls as a directional options trade right at the money. Remember this. I'm going to write this down. It's April 105, and it cost us a lousy $3.55. So if I bought 3 of them, it's basically about $1,000, maybe $1,100. You ready? If I just go to today, they're worth $7.85. So would you be okay making a triple-digit return from, the beginning of November till now? And all you did is just follow the stock up. So for every $355, it's worth $7.85. And remember what happened last year. Now there's no guarantee it's going to go that long. That's why the red line is the stop. When we get below the red line, we're out. This is seasonality. I'm going to blow through here. Steve and Jim, I said I'd try to keep this to 40 minutes. I'm going to try to go another 5 minutes here because I need to do something else. Let me show you this. This was Adobe. This was last year. Now, I'm not getting political here, but remember when the election took place and the new president came in? The stock market went nuts, and it's been going nuts ever since. So let's say you bought a stock like Adobe. You were bullish on them. You thought they'd make a great product. Okay? Let me ask you this. Does anybody want to confess? When the new president came in and the stock market started soaring, you went out and bought a stock. How do I know? What are the odds that you bought the one stock that didn't soar with the whole market? And then we all raise our hands, right? Because it's inevitable. Well, if you bought Adobe on November 7th after the election, you were right for one day. And then it went down. And then it went down again. At this point, you're probably pulling what hair you have left out of your head, like I would be. And then you think, oh man, all right, earnings. There's the dollar sign. That's earnings. Earnings is coming. So Adobe didn't go up with the stock market after the new president was elected. Now, though, earnings, this is going to do it, because everything you've ever been taught as a trader says fundamentals matter. Fundamentals matter. They do matter. But maybe not as much as you once thought. Earnings comes out. The stock gap's higher. That's bearish engulfing on mega volume. Now you're probably thinking of 4-letter words to inject. Saying, are you kidding me? Adobe makes a great product. Earnings can't even drive the stock higher. A new president can't drive the stock higher. You're going to sell the stock. At this point, you throw in the towel and you say, I cannot believe I'm such a bad stock picker. That was probably some of us. But here's my question. Did you check the stock's seasonal track record? Did you check to see when Adobe typically runs like a freight train, and when it seems that as if earnings reports are completely irrelevant and the big money is just not paying attention because the big money is elsewhere? Did you check the seasonality? If you had checked the seasonality, you would have known that January 1st, Adobe goes from being a terrible stock to being an absolute rock star. And look what Adobe did. The election couldn't do it. Earnings couldn't do it. All of a sudden you get to the new year, that's when the capital gets committed to Adobe, and then Adobe runs like there is no tomorrow. It goes absolutely nuts. And the trade is finally stopped out on May 17th. That was another triple digit. I think it was 200 and something % gain. I don't have the exact number, but it was 2 something. I think it was maybe 258. So with seasonality, it's not something where you have to be tied or tethered to the computer all day. You can actually be in Steve's trading room, having a blast. And then we can also look at maybe longer term positions. And then someone said to me, wait a minute, Ron, you just showed me Disney and Adobe. Are you actually telling me that I have to stay in a stock for 4 months? I said, well, first of all, I can't tell you to do anything. I'm not a licensed financial advisor. I said, I don't know about you, but if I could potentially earn 200 or nearly 300% on a long call by holding it 4 months, I don't seem to have a problem with that. Because remember, the reason these things play out over months and not days, when the big money gets in, there's such a huge trader that if they were to allocate all their money on day 1 or day 2 when they want to buy, they would have the stocks going nuts and they're bidding against themselves. They would go vertical. So that's why you see the big buying days stretched out over time. They're not looking to make a quick 5% move in Adobe. When Buffett bought Apple in the 90s, he wasn't expecting a 10% return. They're doing it for the long term, which could actually turn out to be 6-8 months or more at a time, in theory. That's why these things play out. And then if we fast forward to this year, okay, can you please humor me? When did Adobe start running? Didn't I just say a minute ago? Last year, Adobe was such a stinker in December, and literally January 1st, the stock goes on a rampage. Could I have done any better? Look what happened. January 2nd was the first trading day of the year. The second trading day of the year was the third, and then she just popped 16 points. It's absolutely uncanny. And by the way, the list goes on and on and on. I love doing this. I literally could be here with you for hours. So Adobe was not a stock that went up with the new administration in. It actually lagged and went up in its seasonal track record. So no, not all these stocks go up just because the market's running. They actually go up and down because the big money is or isn't behind it. Okay, last one. I want to do, let me see if I can do a poll. I don't know if I'm set up to do polls. Oh, I am. Okay. Let's just type it in for speed. Who here likes pizza? I like pizza, and I got the belly to prove it. So here's my question to you. Do you like Papa John's, or do you like Domino's pizza better? So put a D for Domino's, or a P for Papa John's. D for Domino's, P for Papa John's. And I'll try to quick count this up. D, P, D, P, D, P, D, P. Diana says California Pizza Kitchen. I actually like Papa John's better. Okay, so I'm going to tell you mine. My favorite is Papa John's. Warren says Papa Murphy's. That's not one of the choices. Okay. So about half of you guys like Domino's, and about half of you like Papa John's. I like Papa John's. But let me tell you something I like more. It's that green stuff called money. And I bet you that's what we all agree on. So I'm going to have a little fun with you. I'm going to type in VPZ. Okay. Here we go. You ready? Remember at the very, very beginning, I said to you that, you know this, but, Steve brings you lots of trade ideas. And sometimes you're going to have 3 or 4 that look really, really good. But then you're trying to figure out, I wonder which one I might like better. And then it's like eeny, meeny, miny, mo, right? Because all 4 look amazing. Because you and Steve found them. But what if you could go to Financial and see which one had the better historical track record? Maybe there's one that has like a crazy, crazy good track record, and that might make it more appetizing, pun intended. This was Papa John's. I'm sorry, this was Domino's. This was Domino's last year, right before the Super Bowl. Domino's last year, right before the Super Bowl. This was Papa John's last year, right before the Super Bowl. Would you agree that both charts pretty much looked the same? Would you agree? They both were in sideways trading ranges. They were going nowhere fast, right into the Super Bowl. Half of you guys said you like Domino's, and the other half said Papa John's. Heck, I even said Papa John's. So if we were going to go out and buy stock or options in our favorite pizza company, because maybe you're in Denver or Indianapolis and you're a huge Peyton Manning fan, you all would have probably picked Papa John's like me. And then I went to Financial and I said, show me the data. Opinion's one thing, data's different. And what happened to Papa John's? It went down. What happened to Domino's? It went up. This is the ultimate tiebreaker. It's the ultimate this versus that. Should I maybe buy Chevron or Exxon? Should I buy Halliburton or Schlumberger? Should I buy Kohl's or Macy's? Should I buy Domino's or Papa John's? So how about we trade Domino's bullish, go make our money, and then do a phone order for Papa John's pizza? That sounds like a winner to me. I like money way more. So the next time you find yourself in a pickle and you're trying to figure out which one do I maybe go with, you should have checked Papa John's, because I'm going to show you what Papa John's does. And I'm going to have to put a huge disclaimer, because when you see the data, it does not guarantee future performance. Nothing can. Here is Domino's over the next 10 weeks. Can someone read that? Oh, we're not live, so I shouldn't say it like that, but I think you know what I mean. You want to take a read at the bottom of this chart? Domino's Pizza has risen higher in 13 out of 13 years over the next 10-week period, with a seasonal probability of 100%. Domino's has never had a losing year, ever. Doesn't mean they make better pizza. It just means the big funds come in and that's when they buy it. That's all it is. And if I were to type in Papa John's at this time, it only goes up 66% of the time. So do you want to pick a stock that goes up 2/3 of the percent of the time historically, or maybe pick one that goes up 100% of the time historically? I think the one with the perfect track record is the winner chicken dinner for me. And that's just over that 10-week period. If I were to move this to maybe 9 weeks or 8 weeks, I might get different numbers. If I go out 8 weeks, Papa John's only goes up 58% of the time. And only by 2.9%. That's not much at all. That's like S&P movement. And then if I come up here and do DPZ, which is Domino's, and I look out 8 weeks, even over 8 weeks, the stock goes up 12 out of 13 years by 14.9%. Would you agree, on paper, this isn't even a contest? If I was thinking about buying Papa John's historically, it just wasn't the right call. Domino's had a way better track record. So with financial, you have access to this data too. Now, I want to be respectful of your time. It's been a long day, trading day. What Becky's going to do right now, because Becky's awesome, is she's going to drop you a link. I have nothing to sell you. The link Becky is going to give you is an absolutely free 14-day trial. There's no catch. There's no credit card. It's like a Mission Impossible, cassette tape just disintegrating in front of you. So I'm going to see if I can post the link. Right there it is. So Becky's going to post it. I just posted it for you too. I want every single one of you guys to try it. Whether you use it or not is up to you. It just self-destructs. There's no email to cancel. We have so many members from Steve over at Financial. It's crazy. Next week, I'm going to do a demo webinar. In fact, why not? Tomorrow. Yeah, let's do this. So, tomorrow at noon Eastern, so that's Friday, today's the 18th of January. So Friday the 19th at noon Eastern, I'm going to do a webinar. If you get the trial, you'll get an invite about 1 hour before we go live. So just write it down. I'm going to send you an invitation in the morning. I'll try to get it to you sooner. We'll just make that like a double bonus. I'm not selling you anything. You take the trial, and then you're going to see how amazing this is. So tomorrow we're going to spend less time doing historical stuff, and we're going to do more on stuff that's happening right now in the market. So when you click that link that I put in and Steve put in, All you have to do is put your first name and your email address. Look, there's no credit card. So I can't charge you even if I wanted to. I'm dead serious. When you get over there, go ahead and ask in the chat room, because we use actually the same service Steve does, which is on Novia, or now known as Webinado. And just say, hey, who's from Steve? Because they'll know what that means. And how are you doing? And ask them. And you guys can chat about it yourselves. So it's a totally free trial. It's 14 days. No cost. There's no catch. It just self-destructs. Because some of the stuff that I didn't even talk about was we do have a proprietary algorithm for stock score that actually does take into account technical analysis, fundamental analysis, sentiment-based analysis, and we layer in seasonality. But now you're putting a human component in there, okay? You know, if you wanted to see how Apple does, I think somebody typed in Apple earlier. You know, how many people, how many talking heads on TV only had Apple as a sell for one day? I mean, if you were following our stock score from 120, now you're almost at 180. That's 60 points positive on Apple in the last year. You're probably beating the pants off everybody but Buffett since he bought in the 90s. So we'll talk about that tomorrow too. But I really wanted to drive home the simplicity of seasonality, because it's just crazy. The big money gets a lot, almost too much credit than they actually deserve. They push the same stocks seemingly each year at the same time. So what I said to everybody is the link that Steve and Becky have put in, and I think Jim might have too, you guys click on that link, it tracks you to Steve so I know you came from him. It's going to take you to the page on your screen. Just put in your first name. You can even use your first initial. And give me your email. And you click sign up and you have it. And you're going to have full access to everything on the site. We have a valuation tool, watch list. There's all kinds of great stuff. And then what we're going to do, tomorrow morning I'll send you an email, probably about, figure it's probably going to be like 10, 11 a.m. Eastern, and there'll be an invitation for you to attend the event tomorrow. So tomorrow at noon Eastern, so it's 12 p.m. Eastern, 9 a.m. Pacific, and by taking the trial, you'll automatically get a copy of the recording, so you don't have to email me and say, hey, give me the recording. As long as you register, as long as you get the trial, I'll have your email address so I can email you the recording. So even if you can't be here tomorrow, don't worry about it. You're still going to get 14 days to play around, and next week we're going to do another one anyway, which was my original intent. Okay? Do you guys have any final questions for me? I see we're at the top of the hour. If you do have a question, I'm happy to answer it. Hey there, William. When it crosses the red line, yes, it would be sell to close, yes. So what William is asking is, hypothetically, I mean, just look at Netflix. Remember how we talked about Netflix goes up 70% of the time? Got above the orange line, it was game on. Netflix is gone from 193 to 220 in about 2.5 weeks. And all of our members saw it. The volume returned. It got above the institutional line, and it's game on. Plus, our members knew that in December and January, Netflix has an amazing track record. Now, I got to tell you something. If you got a call on Netflix, and earnings is coming up next week, how do you not take profits? That's really hard not to do, because even though the earnings report is generally a massive catalyst, what if this is the one time it isn't? So you can just simply get out. All the trade ideas are up to you. I do monthly events for all the members. Often it's like 2 or 3 a month to make sure everybody's happy and using the software. But it's all, in the end, it's all up to you. You guys make the calls. You guys pull the trigger. There's no alert service. There's no emails you have to get. We have designed this to be super simple, and you can all have a life, or date or trade during the day, which is awesome too. I typically don't trade throughout the day. I like visiting my friends for lunch, so I'm more of a swing trader. Or if I want to go visit my parents, stuff like that. All right, you want to look at NVIDIA. NVIDIA is another bullish stock. I think there's a few stocks that are after world domination. You have Apple, Amazon, Google, Facebook, and NVIDIA seems to be getting up there. Like they have a lot going for them, it seems. If you look out over the next 11 weeks, NVIDIA goes up 66% of the time. Let's see. If we start going out 12 weeks, it goes up 72% of the time. So it does have somewhat of a good track record, but I think there's better ones that are out there. I'll tell you what, the two that I'm watching now are Take-Two, because I think the moment it clears these highs, it's going to be into blue sky territory. So for me, Take-Two has a really strong track record. So I want to watch 120, and then we have Skechers, which just popped out to new highs. It came right back down, tested the red line, and now it's launching on good volume. Skechers can be crazy good. It doesn't always work, but when this sucker runs, man, it's, what's that old saying? Katie, bar the door. It's like, hold on to your hat. So for 12 weeks, it's 83%. Yeah, it's still saying 10 weeks, 83% of the time, Skechers goes higher by 14.9%. That's a lot. I mean, those are huge moves historically. Verizon. All right, guys. Let's see here. So over the next 10 weeks, just look at Verizon's data. Over the next 10 weeks, Verizon has actually fallen 2% half the time. So it's really a 50-50 thing, Don, whether it goes up or goes down, but it actually has a negative bias. So if I was thinking, hey, would Verizon be a good time to buy? I would say no. The data doesn't suggest it. The good time to buy stuff now is Disney, Adobe, Netflix, Papa John's, Skechers, Valero, United Healthcare, Taiwan Semi. I mean, two of the stocks that we looked at earlier were UNH, and magically they have an earnings report and the stock starts ripping. They were buying UNH. Look at this. They were buying They were buying UNH ahead of the earnings report. And then magically it goes higher. It's like sort of duh. Then you go to Taiwan Semi. They were buying it in front of the report here too. And then Taiwan Semi goes higher. It's just nuts. Again, I want to be very, very clear. Past performance cannot predict future performance. But when's the last time you walked in to a potential trade idea, and let's just say it was on Skechers, and you said to yourself, I did a lot of homework this weekend, and over the next 10 weeks, I feel pretty confident that my stock can go up by 14.9%, 83% of the time. And I would jokingly say probably never. We'd like to be confident in our stock ideas, but I don't know if we'd ever be that confident with those kind of specific numbers. So, all right, I just want to thank Steve, Becky, and Jim. You guys are all awesome. Thank you for having me in. I enjoy coming here. Again, a massive thank you to Steve for being our beta tester when we first took Financial Live, which means I'm also thanking all you guys that are here too, because you guys were willing to come over to Financial, test it, let us know where the bugs were, where they weren't, what you liked about it. And Steve, your people are the most vocal of any group that I think I've ever taught at, because they're always writing in with new requests. So I can't figure out if they're trying to... I think they saw our tech budget and they're like, hey, we can go get more. but they always have great ideas. So, and we tell our members that if you do like something at Financial or you want to see something added, you can write in, and then we put it in a queue. So, Steve, your people are always the most vocal, which we appreciate. All right. So, again, thank you guys very, very much, as Steve says. So, Steve agrees. All right. Seriously, Steve, thank you for having me back. I do appreciate it. Thanks, Jim and Becky, for being here as well. And thanks to everybody else for coming in and spending your evening with me. Steve, I believe Jim said that the recording will be sent out. If you guys have any questions, Becky and the team, they'll be happy to give you our email address. All it is care@financial.com. So it's simply care@financial.com. And then just be sure that if you take the trial and you click on that special link, that's what gets you the 14-day trial for free. It truly is free. And then we'll get you invited to tomorrow's webinar at noon Eastern, okay? And we're going to have one next week too, so don't worry about it if you can't make tomorrow. But if you get the trial today, you'll also get tomorrow's recording if you can't be there live. So thanks again, everybody. Happy New Year, and appreciate you having me in. Bye-bye.
Thank you, Ron.